I'm going to cover a couple things in this video. One, going to use a formula that was in the Warren Buffett way. Talked about how he invested in Washington Post and kind of evolved that formula to buy Coca-Cola. And, Washington Post was a 30 bagger that he scooped up. Coca-Cola has obviously been also one of his better stock picks. So I'm going to use that on the FANG stocks today: Facebook, Amazon, Netflix, and Google. Going to show you how to use an annual report basically to pull out that Warren Buffett formula that he used, particularly when he bought Washington Post. And then, kind of get into that a little bit. I'll try not to get too technical, but hopefully this will give some of you who are maybe basing your growth stuff on EPS or projections or analysts. Maybe some of you just do research from news articles and you wish you could go into deeper analysis without being too overwhelmed. The formula like this can kind of break it down in a simple way, maybe help you learn a little bit better. And we can see, if based on how Buffett looks at businesses and earnings, how is that compared to how the earnings are reported now, and which stocks might be better poised for the future versus which might not. And then, I'll talk about my favorite of the FANG stocks and my least favorite of the FANG stocks. And, we'll wrap that up from here. If there's more interest in this, I could do this kind of an analysis on more different stocks. Definitely just leave a comment if that's something that you'd like to see. So the Warren Buffett formula, he called it basically owner's earnings. And so that's going to be different from the net earnings or EPS numbers that you see in a annual report. And the basic, I know it doesn't look basic right now, but as we work through the example of Facebook, maybe it will start to make a little bit more sense. Basically, you take net income, you add depreciation and amortization, and then you take into consideration non-cash charges. Then you're going to want to subtract the Capex, and then you also want to take into account changes in working capital. So I'm going to decode all of those and just break it down in real simple terms that we can understand, and none of this accounting jargon stuff. First, I'm going to cover a couple of disclaimers. If you ask Warren Buffett, he'd be the first person to say that, hey, there's no such thing as a formula for coming up with valuations and intrinsic values, and that this is just one piece, right? There's a lot of stuff that goes into picking companies, buying stocks, making valuations, finding margins of safety, all of those sorts of things. Charlie Munger would definitely agree with that. Warren Buffett definitely agrees with that. A lot of people refer to valuation as an art and a science. So I definitely agree with that. And there are other factors that made Washington Post one of Buffett's most successful investments that go beyond the fact that he was able to pick up a company at a discount to its owner's earnings. It was quite a significant discount based on the way he calculates owner's earnings. And, there were other things too, like, growth. You have to think about growth, right? Because owner earnings is talking about this year, but what happens throughout the years, you can have your stocks go up in price because of that growth and because of growth in owner earnings and because it was undervalued. And so a lot of different things can happen. And it does not just, not just limited to just one formula. So now that we have those disclaimers out of the way, why pick up owner's earnings? Why even use it? What's the point? I'm going to reference two resources that really helped me out with this. One is my co-host Dave's article on owner's earnings. And he really broke down owner's earnings nicely. I'm going to try to break it down in my own way as well in this video. And I'll also say that Jay June's article called Changes in Working Capital, which we'll talk about once we're getting down into this change in working capital stuff. That part was really, really confusing. And he had a great blog post that helped me figure it out and really broke it down and had a couple examples as well. So I will link up both of these posts in the video. But for now, let's talk about owner's earnings. Why did Buffett like owner's earnings? And basically the general premise behind it is that while earnings tells you how a company did from year to year, how many profits it had. Owner's earnings kind of takes it a step further. Excuse me. And it basically gives a measure of how is the company using its earnings, because once a company has profits, well, it has several options with those profits, right? It can pay out some in dividends, it can do share buybacks, and it can also reinvest into the business. And so I think it's safe to say that some businesses do that better than others, right? Some businesses just might have better business models where you funnel more cash into them and they will create higher and higher returns. So you can get really great measures of accelerated growth through that way. And so high owner's earnings is one way to kind of identify that, right? The second thing is some businesses have to take their earnings and push it back into their own business just to keep things afloat. And so that's not going to be a good thing. We'll discuss that with Capex. But basically, if you have a business that has like a $2 million factory plant, right, that you need in order to create your product, but that you have to put like $500,000 into it every year, well, maybe that company won't be able to grow as fast as a company who, let's say, can have like $1,000 factory plant that only needs to put like $500 into it every single year. And so that's an extra, that difference between $500,000, $50,000, let's say $450,000. It's an extra $450,000 of potential growth that company with the cheaper Capex might have versus a company with the more expensive Capex. So that's kind of the way, that's kind of the differences here. I just want to highlight, everybody has different interpretations of this, and we're using Facebook because their annual reports, the simplest one out of the 4 FANG stocks, in order to make this owner earnings calculation. If you start to try to use this formula on some of the other FANG stocks, I ran into a lot of difficulties in it, and it's not as much of a science in the sense that it does matter what your interpretation of it is, what your interpretation of the various metrics are. So definitely, if that's something you're struggling with, if you're trying to run these with the other FANG stocks and you're having issues, and you'd like to see me make a video about that, let me know. If I don't hear anything, I'm going to assume you guys are doing fine. But I know with some other resources I've seen, people were kind of complaining that the hard part of using the owner's earnings formula is that there's a lot of judgments that need to be made. Obviously, not every annual report's going to be exactly perfectly the same. There's going to be little differences in some of these side tabs and different ways to call it certain things. And so you have to have kind of a mastery in a sense of how to put that into each particular category in here. Luckily for us, Facebook's easy, so that's what we're going to use. Last thing before I dig into the numbers. And this is my opinion, this is my interpretation of owner's earnings. These are the two, let me make sure my levels are okay. Okay, good. These are the two most important aspects of this equation, in my opinion. Depreciation and amortization and Capex. And so I alluded to Capex just a second ago, right? Where basically, if a business needs to put a lot into Capex, they're not going to be able to retain as many earnings. They're not going to be able to reinvest as many earnings. And they're going to have to, it's going to be costly in order to keep the business alive, and less capital is available for growth or to be paid back to shareholders. The other aspect of this is depreciation and amortization. So basically the way that works is, let's go back to that example with the plant, the manufacturing plant, right? Let's say it's $1 million to build. Let's say you can build one, and even though, it costs $500,000 to maintain every year, let's say you can build one and you don't have to replace it for 10 years. So that means in year 1, you spend $1 million, you built the plant, and it's good for 10 years. So year 2, year 3, year 4, year 5, you don't have to keep buying new plants. You have that one plant, and so that's it. However, if the way accounting works, and trust me, I'm going to make this as simple as I can, is that, in the real sense, with the real business, if you were to just put, $1 million as an expense in year 1, That's not necessarily an accurate representation of how the real business is working, right? Because whatever years that they add a plant, it's going to make their profits really, really small because now you have this $1 million expense. So the way that accountants try to smooth that out, and this is currently the way that GAAP is organized, is they will depreciate it over the life of its useful life. So instead of taking $1 million and putting that in the expense column for year one or whatever year they bought a new plant, they will divide it by 10 years and then add that depreciation every single year. So you kind of space it out so you get a better picture of how the profit is for any particular year because you're spreading out the costs instead of piling it all into 1 year and making that 1 year look bad when that 1 year could have been great of business results for the business, right? So that's the general scope of it. Amortization is similar but different. I don't want to get into that too much, but basically it has to do with the same thing but with like intangible assets. So think like a patent, right? If the patent expires in 5 years, well, it's giving value to the business in 5 years. You amortize that over 5 years. Luckily for us, again, Facebook they put DNA in one row for us, so that's really, really nice. So what we're going to do to use the formula to calculate our owner earnings for Facebook, we want net income and depreciation and amortization. Both of those things can be found in the cash flow statement. And by the way, if you want more insight on how to look through an annual report, because I'm going to go pretty quickly, definitely check out my 10K tutorial playlist. That's pretty extensive, but I'm sure once you're done with it, you'll probably master the 10K and you'll be able to glide through it the way I do. And it's super useful. It's basically the difference between a great analyst and one who's not, right? Okay, so looking at 2017, 15,934, and I'll kind of just input these and then I'll highlight them when I'm done. So here's depreciation and amortization, 3025. Non-cash charges. So what's this going to mean? This is like our operating activities. And there's going to be other stuff, other adjustments, right? Because net income, that's what we're talking about, is just what Wall Street uses. That's what they use for EPS. With owner's earnings, we're trying to factor in the other things that we just talked about, depreciation, amortization, and Capex. And so these other two non-cash charges and changes in working capital, like I said, I don't want to go through them because they're not as big as depreciation and Capex. But they do have an effect, and it's basically the same concept where we're trying to avoid we're trying to get a better scope at the real cash flow of a business and a better scope of which ones are going to be poised to become like a compounding machine, basically is the way Buffett likes to word it. So we're just going to do this one. And it kind of goes hand in hand with the way Buffett likes to invest, because he likes to invest in high ROE companies or companies that are historically been good at ROE. And so those are companies that are really capital efficient. And so by making this version of owner earnings, it really highlights the ones that are going to have high return on equity, plus the ones with good owners earnings are going to be the ones that have that kind of explosive, really fast accelerating growth. That makes them a compounding machine that will make them likely to become great investments. So for non-cash charges, what I just did was I added share-based compensation. So basically that's kind of like stock options, right? But basically the idea is you have to take it into account, but it might not necessarily have been cashed out yet. So we're trying to get more sense of what the real cash flow is. So it didn't come out in cash from the company, but they did have to report it in their profits. So now we're just adding it back in because no cash was actually paid out. Deferred income taxes and other, it's going to have a similar kind of logic. Capex. Now this is what we were talking about with property and equipment, right? The manufacturing plant. So in the case of Facebook, we're just going to look at their property and equipment here. So that's 6733 is how much they spent. And so I made this formula that's up top. I made it here, so it's going to calculate it for us. And I could have put a negative number for Capex. That means I would have had to have a plus sign here, but there's a negative here for the plus there. Now, working capital, this is where it gets really complicated. This part I struggle in, and basically, the easiest way I can explain it is that we're gonna want to see basically the bigger change in working capital, the better. And so we want to exclude cash, but basically we're looking at like accounts receivable, inventory, stuff like that. So if a business is able to have better change in working capital, then basically they're becoming more efficient. They're not needing to carry as many inventory pieces. So it's like a measure of being more profitable, right? So it goes hand in hand, and I could probably do a whole 20 minutes on just that topic. But if you want to get and I can talk about a lot of stuff. You guys feel free to comment and let me know what you want me to talk about. But if that's something that I end up never making a video on, that resource that I'm going to link up will be very helpful for you. Jay June's article, that was a good one. So total, we're just taking assets and liabilities. So accounts receivable, and then prepaid expenses, other assets, and then we're going to take the total current liabilities. So basically, that's not good. They in 2017, it took them more inventory, more accounts payable. They didn't have as many basically, they didn't have as much cash to play with in order to create the earnings that they made. So they needed more cash to create this kind of earnings. So it adds a negative to our total owner's earnings. And so that's the basic concept of it. All right. So now what we can see with Facebook is if Buffett were to use his formula that he used in 1973 with Washington Post, he would see owner's earnings slightly lower than the net income earnings. And so what that can tell us is maybe Facebook has higher Capex expenses than that's not really being thought about, right? Maybe the working capital problems means that the business isn't as efficient. The business model might not be as efficient, right? So that's just something that you can use as a starting tool. And then I'll show you, I already did the other FANG stocks, so I'll put those up here now. So what we can see with the other FANG stocks is Amazon 3 times more owner's earnings, almost 4, than what they report in EPS. So there's one where it's like, okay, that's a huge difference. And so depending on how the valuation is in the market, there might be opportunity there. That might be something that Buffett would consider further. Depending on market levels for the stock at whatever time you're looking at it. Netflix. Turns out Netflix is a pretty, cash intensive. Look at that Capex, right? So let me make a note that all this is in the thousands. While the other stuff's in the millions. But, huge Capex. What's that? Almost half of their net income goes to Capex. And that makes sense if we think about the business, right? Because they spend a lot, at least right now, they're spending a lot on, on content. I've heard reports of them saying that they're paying their actors or directors or whatever for all these original series they're trying to come out with, and they're paying them 5-10 times the industry standard, trying to attract as much talent as they can. That's costly, and it shows up in the Capex. And then Google goes from 12 to 18. So that's pretty interesting. The last thing that Buffett says, and this is what's talked about in this Warren Buffett Way book, is the next thing he'll do once he has owner earnings numbers is he will divide it by the risk-free rate, and that will give him a valuation. So I know that's confusing. Let me just try to make it simple, right? So right now, the risk-free rate, and what is referred to by that means the 10-year Treasury bill, Treasury Yield. Right now, let's call it 3.1. So what Buffett would do, I like to make things pretty. Like I said, he would take remember my disclaimer on this. He would take owner's earnings, divide it by the risk-free rate. That would be like a rough valuation point. Gotta love this stuff, right? So if we compare it to like current valuations, I'm going to use FinViz because that will let us display all of the market caps all at once. So if we do the FANG, what is it? FB, Amazon, Netflix, and Google. So here's our market caps. Facebook at 470 billion. Compared to right now, it's valued at 518, so that one might be overvalued. Amazon at 367, that one might be pretty undervalued. But remember, those owner's earnings, Amazon's pricing in 250 on the PE. So if you multiply that by 3, Buffett's saying they have 3 times more earnings. Well, now we're dividing 250 by 3. So the PE on that's more like what? An 83. So, might make the PE that Amazon's carrying a little bit more reasonable if people think that 83 PE price multiple is kind of sustainable. Remember, this is in thousands, so this is really like 14 billion. That would make it way undervalued. And then Google, just slightly overvalued. So that's kind of the whole thing. Again, remember my disclaimers on the valuation. It's not like an exact science or anything like that. I would just say, I question the whole risk-free rate thing. Here's why. When this changes, you can see that there's going to be huge differences in these valuation numbers. So let me show you. Like, if the risk-free rate was like 1%, which is what we saw for a while, really back in like, what was it? 20, I don't remember the exact years, but we had 0 interest rates basically. We had really, really low interest rates for quite a while. So, the idea is when this is at 1%, the valuations go much, much higher. So now, basically based on this Buffett valuation, it would be Facebook at 1.4 trillion, Amazon at 1.1 trillion, Google at 1.8 trillion. And I think that's completely unreasonable, obviously. If it were at something like 5%, now you're looking at, basically the way I see it's like the higher the risk-free rate goes, the more reasonable these valuations get. But I just don't think it makes a good estimate. I'd rather use PE. And base PE based off owner's earnings rather than net income, which is what everybody else is using. So I get the logic behind it. Basically, what you're thinking is you're comparing, well, I can only get 1% on the Treasury bill, so any stocks are going to be more attractive because they'll give me a higher, they should give me a higher yield, maybe a higher, I guess that's basically the idea. You get a higher yield than the risk-free rate. So that makes these businesses more valuable. And then the higher interest rates go, the less valuable these businesses come, because you can be putting money into treasury bills instead and be getting close, pretty good returns compared to maybe what you would get at a certain business or a certain stock, depending on what their earnings are like. So again, that's the other thing I will say. So definitely take that with a grain of salt as well. And what to finish off the video, kind of what I said earlier, if I had to pick one of these 4 stocks, I would definitely pick Google. I think there's, we can go deeper into it, but it's obvious that they have more owners' earnings than net income. Capex doesn't seem too terrible. Actually, Capex is really bad. It's more than their net income, but they also have high depreciation amount. So it's like, the high depreciation kind of implies that they've been investing in the future quite rapidly. And, a thing about Google and, amortization might have something to do with this too. And I think amortization for Google might be underrepresented, possibly. Basically, like the idea of Google's brand, the idea that so many people go to Google. And I think the idea that there's just not as much competition with Google as far as like search engines. I mean, I guess Bing would be the second closest thing, right? But here, let's look at something like this. If we look at, I know a lot of you probably don't know about this tool. Because it's not really a Wall Street tool. It's not anything like that. So what it tells us is kind of like what kind of traffic these sites are getting. And so you can kind of get a sense of, it's not going to give us as accurate of a representation of market share as like revenue would, but it can kind of give us a sense. So there should be total traffic somewhere. Let's just do it this way. That's kind of annoying. I guess if we compare that to like Bing. I might be blind. I don't know if you guys can see. Yeah, advanced plan. You got to subscribe, of course you do. But I mean, you saw Google's the #1 website in the world. Bing looks like the 45th. So there's a big difference there. And I don't know what the exact visitor numbers are. Looks like they're probably getting growth internationally through China. And, Microsoft owns Bing, so keep that in mind. But it's just the fact that Google is just the go-to. And then you got YouTube. And I think YouTube's really high up there as far as user and eyeballs. And so I just think the way amortization works of intangible assets, usually it's something. So yeah, 1 and 2, Google and YouTube. So there's just a huge gap in competitive moat. So that could make intangible assets undervalued. It's possible it's not being reflected in their goodwill, which is their balance sheet, because goodwill only happens when you acquire a company. I understand it's a lot of jargon, but those are all factors, right? And then if we compare like Netflix, and you want to do like, basically their big thing is streaming, right? That's Netflix's butter. But then let's compare it to some of the other companies that are getting into streaming. There's Disney. I think, who else is in the game? I mean, basically every cable company is in the game because they're moving pieces to the streaming world. And I'm blanking right now on like who the cable companies are. I know some of Disney's competitors are definitely playing in the streaming game now. So yeah, Comcast, Time Warner. Let's use these guys. Disney, Comcast. Time Warner and CBS. I mean, you're looking at huge market cap. The big thing to me is like looking at these revenue numbers. So revenue of like $9 billion, Comcast revenue of $150 billion, CBS. And so, it's like a race to see who can do more content, right? 1.7. Comcast 10. Sorry, I was looking at the wrong one. Comcast at 10. And what's Netflix at? Netflix hasn't reached $1 billion yet oh, here we go. Sales 12 billion. Sales 14 billion. Sorry, this whole time I'm trying to do this quick. Look at 86 billion. Disney 56 billion. Disney I think they just either are about to have complete ownership stake in Hulu, or if the Fox deal goes through, maybe then that gets finalized. I don't know the exact details on that, but we're looking at a small fish playing against all these big entertainment media conglomerates who are a little bit behind, but they are starting to move into streaming. And so that really provides a lot of risks for Netflix, especially in what they're trying to compete in, content, what will keep people on, what will keep their eyeballs on, and let these companies monetize. It's going to be content. And so they have been spending a lot to try to make up that gap. But, Disney is Disney. They've got so many different content things, so many TV shows, and it's going to be tough. It's going to be tough. So I'm not saying you should short Netflix. I'm not saying you should buy Google. I'm just saying between these companies, between kind of what we saw here in owners' earnings and some of my other viewpoints on the FANG stocks, if I had to pick one, I would pick Google. If I had to get rid of one, I would get rid of Netflix. And those are kind of my thoughts. So hopefully this was helpful. Again, if you want to see more of this kind of stuff, if you want more in-depth Buffett formula stuff on other stocks, feel free to comment, and I'll see if I have some time to put those in. You have 3 options from here. I would recommend the 10K tutorial playlist I have, or the how to use valuations to analyze stocks playlist. Either of those can be very helpful for you if you kind of like this numbers-based approach that I just showed. But definitely subscribe to the channel, click on the bell, make sure you get notifications, and you'll see some of my new videos show up on your feed when you're scrolling through YouTube. And subscribe to the email list over at stockmarketpdf.com. You'll get a free ebook and you'll get daily tips. So again, that's stockmarketpdf.com. I will put this spreadsheet in the shared Google Drive folder, and so that's available for daily email list subscribers. And so you can kind of play with it and take a look if you want. And finally, so those are your 3 options. Subscribe to the channel, subscribe to the email list, and check out the 2 playlists. Stop working for money, put money to work for you. Talk to you next time. Thank you very much.